Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for December 7th, 2020. Please see our disclaimer for important information. On our Market Minutes this week, we have a little bit to talk about. Obviously, the big news is in the equity markets. Stocks are continuing to rally, and markets are firmly above their pre-pandemic highs. We've seen a lot of news in the vaccine department here, more availability expected next year, and that should probably lead to more normalized economic conditions. And I'd say that maybe looking at the glass half full, half empty argument, I do think that a lot of this news is priced into the markets, and valuations appear to be relatively full at this point. But I still believe just the overarching view is that the landscape next year for the investment markets is going to be conducive. But we're going to have to get through kind of a rough stretch of some adverse data, I think, just related to curbs on commerce because of the pandemic, kind of this last big surge before we get the deployment of some vaccines. But we'll talk about some of this as we go along. We've got some data to share with you, kind of looking at last week, and then we'll give you some perspective on what all that means. But last week, the S&P kind of moved a little bit higher throughout the week and ended at another all-time high. And we got a little bit of a positive, updraft, if you will, from the increased prospects of a stimulus bill. And it does look like that people in the middle are coming together to try to forge a consensus on something that is slightly more than $900 billion, and President Trump has indicated he's going to sign it. So that gave the market a little bit of a tailwind last week. But the S&P last week was up 1.7%, Dow was up 1%, NASDAQ was up 2.1%, and the Russell was up about another 2%. And the S&P 500 actually returned 11% in November, and it's up 14.5% year to date. Now the Dow year to date is up 6%, and that had been a consistent laggard throughout the year. NASDAQ is up about 39%, Russell 2000 is up 13%. Obviously a big differential relative to international markets, which, frankly is where all the value lies. But again, it's value that is struggling to find that catalyst right now. But if you look at essentially the MSCI EFA index, which is Europe, Africa, and Far East, that's only up 3.1% for the year. Emerging markets are about 12%. They've had a little bit better run. But stocks in general have been across the globe have been a little bit better, because even those international indices for the quarter are up 12, 13, 14% for that quarter, even if they're lagging far behind on the year-to-date number relative to the U.S. markets. But in the credit area, we've got the Barclays aggregate, which is fixed income, up about 6.8%. For the year, down slightly in the few days of the month here. Leveraged loans also up about 2.3%, and high yield loans are up about 6%. Getting over to commodities, we can see here that crude is holding in about a $46 a barrel level. That's down 24% year to date. Gold is seeing a little bit of froth taken off the edge. For the quarter, it's down about a little less than 3%, but it's still up about 20.5% for the year. And as the dollar goes, and we do expect to see some continued downslide in the dollar, but dollar's off about 3.4% for the quarter, down about 5.9% year to date. So we'll continue to monitor that. But then if you look at 10-year Treasury rates, we've had a continued rise kind of off of this interim trough that we saw earlier this year. 10-year Treasury yields about 97 basis points, almost 1 full percentage point. The Treasuries were up 13 basis points in yield last week. You know, and we'll talk about this economic data, but we had a little bit of a disappointing jobs number. And we've seen a lot of traction in the labor market, but then we've seen it just kind of stall out periods, and last week was one of those periods it appeared to really stall. But, you know, again, I think the market is reacting positively to bad news, because what that does is seem to drive us a little bit closer to a stimulus bill, which the market's been aggressively pricing into markets right now. But yeah, kind of the puts and takes and all that is, you know, that there's a kind of a general bias towards increased levels of inflation in 2021, certainly relative to this year, and maybe a little bit more of an updraft in 2022 as the Fed continues to hold short-term interest rates very, very low to allow that inflation number to kind of expand. But you know, we've got a lot of noise in the energy market, so we don't think we'll get a lot of perhaps inflationary pressures from the energy markets. You know, OPEC plus had delayed some production increases, so that kind of helped put a lid on prices. But you know, just kind of looking briefly at the economy, I talked about the labor market. And employment gains slowed quite a bit. So that gives some thought that maybe that the momentum in that recovery is stalling out a little bit. Unemployment rate in the jobs report was down to 6.7. That's down from 6.9. The other thing that I paid attention to, and I think it has implications for economic growth, is the participation rate. And that right now it's sitting about 61.5% of the labor force, and that's almost 2 percentage points below pre-COVID levels. And you think about that, you know, and what that amounts to in terms of, you know, literally millions of workers. I mean, it's not insignificant, and this could prove to be a bit of a drag. And maybe a theme for 2021 is that we've got difficult participation, lower participation, and you know, essentially the longer the people are out of that workforce and not in the labor pool, the harder it is to get back. But you know, meanwhile, we've got a couple of, you know, perhaps on the positive side, that both the Institute for Supply Management Manufacturing Index was fairly steady, and the ISM service number was also fairly steady, and those were clearly in expansion territory. So you know, those were positive developments. Another theme, like in the equity markets, that I wanted to highlight is the fact that value has really kind of come back. Small caps have kind of come back, and we have more breadth in the market now. We've got 91% of the S&P 500 that's above their 200-day moving average, which is a fairly stout and broad-based measure of support in the index. And again, there's a lot of euphoria that's built into this. And so I want to be real careful to not assume that this is going to happen in perpetuity. But needless to say, it is much broader based in terms of the price movement than anything that we saw this summer, which is, back then it was largely driven by just a small handful of stocks. So as I mentioned, we've got a $908 billion proposal that's kind of been put out there on the table. Looks like there's a little bit of momentum to that. In the charts of the week, this week I've got kind of a breakdown of what that implies. Key things there is going to support municipalities. We know that hiring has been down at the municipal level. We know that budgets are being constrained because of lower tax revenue in a lot of cases. And then the other thing that is kind of being discussed is liability protection. It's a big deal on the GOP side. But in any case, we've got we've got some heavy lifting left to do there. On the labor market, importantly, that participation rate. I failed to mention this, but it's important that we had essentially 400,000 people left the workforce, and and then that had actually a bearing on why the unemployment rate dropped a little bit. And it's like I talked about, municipal job growth declines, if you will, or negative job growth. We've got a lot of government and education jobs that have been lost since February, and we've less seasonal hiring this year. And just is all in evidence in the numbers that we saw, in the November jobs report. I mean, we added 245,000 workers, and we were expecting 200,000 more than that. And like even back in October, it was over 600,000. So, again, to the notion that we might be slowing down a little bit in the labor force because of the pandemic, again, I think we could assume that number begins to pick up a little bit of momentum next year. But right now we've got chop in the data. But so to date, the market's regained about 12 million of the 22 million jobs lost. And importantly, we've got 4 million workers that are enduring kind of a long-term joblessness. And that number was up almost 400,000 in the last reading. So, I think we need to monitor the labor situation a little closely. And obviously, we've talked a lot about the plight of the small business sector, and small business accounts for, over half of the jobs in this country. But if you define it by those with less than 50 employees, that's a huge number. But again, going back to stocks, we've got November's 11% return was the best that we've seen since 1928 for a November. We had 467 stocks in the S&P 500 that rose last month, and in October we had 212 that rose. In September it was 153, and we've got a lot greater participation, like I said, profits were down overall. Now that we've had all of the third quarter reports kind of in the rear view mirror that we can reflect on, profits were down only 6% year over year, and expectations were going into the reporting season, we're calling for like a negative 21% change. And as a result, I think there's a bit more euphoria in the market. And then we've got a lot of high valuations, a lot of IPOs, a lot of these reverse merger, special purpose acquisition companies that are taking people public. And we have just, I think the risk of having stocks being revalued relative to rising yields on fixed income. But, interestingly enough, and I had some data on this, but, the yields and yield spreads, especially in high yield, it's just phenomenal how low yields are, even on very speculative grade credit, and so it just shows you that there's a lot of liquidity in the system that's looking for yield, that's looking for a home, and is really risk on right now. And we've seen a lot of debt issuance, and I think I do worry a little bit about the long-term implications for maybe credit defaults, because there are a lot of people that are stretched. A note in the Wall Street Journal, basically companies and governments have issued almost $10 trillion of bonds and other kinds of debt this year, and that includes $5 trillion of corporate bonds as well as some leveraged loans. Global debt has risen 15 trillion to 272 trillion in the first 9 months of the year, and will probably hit almost 280 trillion by year end. And that would be, by this article's judgment, would be 365% of world GDP. American companies with investment grade credit rating. These are not the speculative companies. These are investment grade credit ratings. They've issued more than $1.4 trillion of debt, and that's up 54% year over year. And junk bond issuance is up over 70%. So we've got a lot of people that are issuing debt out there. At the same time, we've got cash that's being hoarded by non-financial companies, and that grew to a record 2.1 trillion at the end of June. And that's up 30% year over year, and it's pretty amazing that we've got corporate balance sheets that are saddled with debt, but at the same time they're raising it and they're hoarding it. In addition to that, during the pandemic, they've cut repurchases of their stock on the open market. They've cut dividends, and they certainly have cut capital expenditures during this time. And that actually could be an interesting sign for next year. I think high levels of cash on corporate balance sheets could absolutely begin to be deployed next year, and that's going to be an interesting dynamic as we head into 2021. Growing their dividends, buying back their own stock, and then obviously perhaps paying down some of this debt that they took on in the pandemic, but have found maybe that they don't necessarily need. But we're still watching inflation. I think inflation is on the doorstep. But question is, when does that door get opened? And I think it may be a little while. Market will begin to anticipate it, as it frankly already has a little bit. But we've had really low inflation this year, and I think mathematically it's tough to envision a 2021 where that inflation number just isn't simply higher. And then I think as we kind of exit the pandemic, some of these areas that have really struggled, like leisure and hospitality, will begin to regain a little bit of pricing power that they certainly don't have right now. And then I think more spending, capital spending on the part of companies and whatnot, and I think it will begin to drive inflation here in the next, certainly in the next 2 years, but it may begin next year, and we'll have to watch that. A handful of observations before we conclude today. We talked about the jobs report. I think it's taking a little bit of a toll on near-term economic growth. But I do think that we're going to have more positive trends in the unemployment rate next year. Manufacturing, we talked about manufacturing being in solid territory. Maybe it was off a little bit, but I think it's okay right now, clearly in expansion territory. But we are going to get some negative near-term economic readings. I think it's pretty clear that that's going to happen. It'll be interesting to see how the market interprets that noise, if they can look past it. But essentially, we've got this, the prospects for a near-term fiscal stimulus bill are improving. It'll support small business individuals that are getting unemployment benefits. To some degree, it'll support state and local governments and perhaps education and healthcare within the economy. But the weaker U.S. dollar, and I think the dollar could go lower. It will certainly help exporters. It certainly will help emerging markets. Commodities will benefit from a weaker dollar, and cyclical stocks will certainly benefit from a weaker dollar. So, I think, as that dollar remains weak, I think it does provide some feedstock into the potential, growth in the market next year. And then we've also got metal prices, like copper, that are, I think anytime you see, prices for industrial metals go up, that's a positive sign. And let's see. Yeah, and let's see, economic lockdowns. You know what? we're at a point now, just looking through the final set of notes that I have here to talk about. Really, it's not worth belaboring the point. I just think we're at a point now where, we're at an interim peak. I think there's risk of having gains be consolidated, as we head into the end of the year, maybe the beginning of next year. We're going to have a stretch of lower volume in the market, just, as typical during this time of the season when you get holidays and people are out or they're taking, days off and whatnot. So, I think that, the recent rally may have kind of produced an overbought condition, and it was up, basically 10% last month, and valuations actually do look stretched. We look at this, 10-year cyclical, cyclically adjusted PE ratio, or what they call the CAPE ratio, and right now that price to earnings ratio is at 33, and the only other period which it was above 30 was in the 1920s and the early 2000s. So I think that we're in rarefied air right now, and we probably run a little bit of a risk of a pullback. But I would probably take opportunities to buy into dips and hold. I think perhaps having a little bit of portfolio insurance isn't necessarily a bad thing right now, and we certainly have some of that. I think beginning to test and increase allocations in international markets. If you're going to have a global recovery, it may not be quite synchronized in 2021, but to the extent that you have most of your areas begin to recover as the vaccines are deployed and people are getting back to work, that I think you'll have a positive response in international stocks. So I would certainly be kind of intrigued with the notion of being able to get cheaper valuations there now, and I think to some extent in emerging markets too, because I do think the dollar is going to remain low for quite some time. And I think we have such a relatively low real yield now because expectations seem to be picking up at the same time that interest rates are really not moving that much. So that negative real yield continues to go, and that's going to help. I think gold, it's certainly going to help cyclical stocks. It'll help probably keep that dollar low, which will have a lot of downstream benefits for international investors. But really, I'd say I'll conclude on that for this week. Be watching the markets heading into the holiday season. We've got a little bit of time left to Christmas. We're going to be talking about holiday shopping trends, and we're beginning to get some of this data back. So I'll probably have some more of that information for you next week. And we'll also be very interested to see what the travel landscape looks like as these coronavirus cases are really picking up at the same time that death rates are actually continuing to go down. And you'll see that in our charts of the week this week as well. But in any case, that will do it for this week. And we appreciate you spending some time with us. Thanks for taking the time. We welcome your questions or comments at the information you see here. Please don't hesitate to reach out. I hope you have a great week, and we'll talk to you again soon.